Hey everyone, and welcome back to Safe Simple Sound, your go-to podcast for making sense of money matters. I'm your host Alex, and I'm thrilled you're joining me today. Today's episode is all about a topic that resonates with so many of us: finding that sweet spot between financial security and the flexibility life demands. We're drawing inspiration from an insightful article on our very own Safe Simple Sound platform titled Financial Security with Flexibility. Is Safe Simple Sound your answer? So, get comfortable, maybe grab a notepad, because we're about to explore how you can build a financial future that's both protected and wonderfully adaptable. Let's get started. First, we're diving into a theme we call the tightrope walk, defining financial security with flexibility. It's all about finding that sweet spot. And to kick things off, we're looking at a very common situation: the young professional's dilemma. Imagine Sarah. She's 25, a graphic designer, super excited about her career. She's also dreaming big: a condo in a few years, maybe some travel. She's trying to be diligent with saving, but, she also wants to enjoy life now. Plus, her industry is dynamic, so thoughts about unexpected job changes are always in the back of her mind. She's asking herself, how do I build a secure financial base that doesn't feel like a cage? It's a classic scenario, and I think many of our listeners, especially those in their 20s and early 30s, can relate. Sam, Taylor, let's unpack this. Sarah's situation really highlights the core tension. Sam, I'll start with you. From your perspective, what are the biggest financial anxieties for young professionals today when they think about balancing immediate desires with long-term security?
That's a great starting point, Alex. For young professionals like Sarah, there's often a trifecta of anxieties. First, job security in dynamic industries, as you mentioned. Second, the pressure to keep up, whether it's experiences, lifestyle, or visible markers of success, often amplified by social media. This clashes directly with long-term goals like home ownership. And third, for many, there's the weight of student debt, which can feel like running a race with a backpack full of rocks. They see the importance of saving, but the path feels crowded with competing priorities and an underlying fear of missing out or making a wrong choice.
That really resonates. It feels like you're constantly being told to save for retirement, buy a house, pay off debt, and live your best life, all at once. It's overwhelming. And that anxiety, for me, often leads to inaction. You freeze because you don't know which financial lever to pull first. It's like, if I save aggressively for a condo, am I missing out on experiences I'll regret not having when I was young? Or if I travel, am I being irresponsible about my future?
That's a powerful point, Taylor. The paralysis that can come from too many competing goals and anxieties. So this brings us to a key term we're discussing: flexibility. Sam, for someone like Sarah who might see flexibility as just another word for uncertainty or not having a real plan, how can the concept of flexibility be a positive driver in financial planning, rather than a source of uncertainty for someone just starting out?
Excellent question. I think the reframe here is crucial. Flexibility isn't about planlessness. It's about adaptability. Think of it like the reference article we discussed earlier, Alex, with Shelby the Trustworthy Tortoise. Her shell provides robust security, but she can still move and adapt to her environment. For Sarah, financial flexibility means her plan can absorb shocks, like a job change, or embrace opportunities, like a last-minute travel deal, or a sudden inspiration for a side hustle that needs a small investment without derailing her core security. It's about building a plan that bends, not breaks.
I love that Shelby analogy. So it's not about having a flimsy plan, but a strong one that's also agile, like a suspension bridge, designed to sway a bit with the wind, but remain fundamentally sound.
So if I understand correctly, flexibility means your financial plan isn't so rigid that one unexpected event, good or bad, throws everything into chaos. It's like the plan itself has some give. That actually sounds less uncertain in a way.
Precisely, Taylor. A flexible plan anticipates that life will change. It builds in mechanisms to adjust. For instance, having different savings buckets, one for the emergency fund, one for the condo, one for opportunities, experiences. The act of saving is consistent, but how you allocate between those latter two buckets might shift based on evolving priorities or circumstances. This adaptability reduces the feeling of being trapped by a decision made years ago.
That makes a lot of sense. It's about creating options. So let's get practical with Sarah's scenario. She's juggling saving for that condo, wanting to travel, maybe paying off some student loans, and trying to build that emergency fund. When you're juggling all of that, Sam, where does security fit in? And how does flexibility help you stay on track with those varied goals?
Security is the bedrock. For Sarah, this means prioritizing a robust emergency fund first. That's her primary shield against unexpected job changes. It's what gives her the confidence to even think about bigger, more exciting goals. Paying down high-interest debt would also fall under security because it frees up cash flow and reduces financial fragility. Once that security layer is strong, flexibility comes into play with how she pursues the condo and travel. Instead of seeing them as mutually exclusive, a flexible approach might involve 1. Tiered goals. Perhaps the initial condo down payment goal is for a smaller starter place, making it achievable alongside some travel. 2. And both savings. Automating savings into separate accounts for each goal, even if the amounts are modest initially. This builds momentum for both. 3. Opportunity funding. Having a specific, smaller fund for travels, experiences that she contributes to. If a great opportunity comes up, the money is there, and it doesn't raid the condo fund. 4. Periodic review. Every 6 months or year, she reassesses. Did she get a raise? Her travel itch might be stronger than her condo itch for the next year, so she might temporarily adjust her savings allocation. Flexibility means the plan can accommodate that shift without guilt or derailing the overall secure foundation. This links back to our secured philosophy, particularly embrace mastery of cash flow and embrace financial flexibility.
Okay, that breakdown is really helpful. So security isn't just one thing, it's foundational, like the emergency fund being non-negotiable. Then flexibility allows you to pursue multiple wants in parallel, adjusting the intensity based on what's happening in your life or what feels most important at that moment. So Sarah could decide to really go hard on condo savings for a year, then maybe ease up a bit and put more towards a big trip, knowing her emergency fund is still solid and she hasn't abandoned the condo goal, just tweaked the timeline.
Exactly. And that proactive tweaking, that ability to adjust without feeling like you failed at your plan, is where the power of flexibility really shines for young professionals. It turns financial planning from a restrictive chore into an empowering tool. So, to quickly recap what we've discussed for young professionals like Sarah, key anxieties often include job security, lifestyle pressures, and debt. Flexibility, rather than being about uncertainty, is about building an adaptable plan that can handle life's changes, much like Shelby the Tortoise. Security forms the non-negotiable base, while flexibility allows for pursuing multiple goals, like saving for a house and travel, by adjusting allocations and timelines as needed, without compromising that core security. This really sets the stage for how individuals can start to feel more in control, even when the future feels a bit unpredictable. As we continue to explore the tightrope walk, next we'll shift our focus to a different life stage. We'll look at the growing families balancing act, where the stakes often feel even higher, and the need for both security and flexibility takes on new dimensions when kids and mortgages enter the picture. But before we move on, for our listeners, especially those who see themselves in Sarah's shoes, here's a thought to consider. Assess your current savings strategy. Does it allow for unexpected opportunities or setbacks? Really think about whether your plan has that built-in adaptability we've been discussing. In our last segment, we walked alongside Sarah, the young graphic designer, as she navigated building a financial foundation while craving flexibility for her dreams. We talked about how critical it is, even early on, to blend that desire for adventure with smart, adaptable financial planning. Now, we're shifting our focus to a different, yet equally dynamic life stage, the growing family. Let's talk about Mark and Lisa. They're parents to 2 young children, juggling a mortgage, childcare costs, and the big goal of saving for their kids' education. And to add another layer, Mark's considering a career change for better work-life balance, which could mean a temporary dip in their income. They're looking for that sweet spot, security for their family's future, but with enough flexibility to make these big life decisions without derailing everything. Sam, this scenario resonates with so many. For families like Mark and Lisa, with young children, financial pressures can feel immense. What's the first step towards finding a balance between those pressing day-to-day needs and long-term security goals like education funding?
That's a crucial starting point, Alex. The very first step is gaining clarity and then prioritizing. It's about sitting down, perhaps with a professional, and getting a crystal clear picture of their current financial landscape: income, expenses, debts, existing savings. Then, much like we discussed with the C's financial control aspect of our secured philosophy, they need to define their non-negotiables, what absolutely must be covered for their family's security. This often includes housing, essential bills, and foundational protection.
So it's almost like they're triaging their financial goals, identifying what's critical for survival and well-being versus what's aspirational, especially when things like education funds feel so far off compared to childcare bills due next week.
Precisely, Taylor. And it's not about dismissing those long-term goals, but rather about building a sustainable path towards them. Once the non-negotiables are secured, they can then allocate resources to other goals, like education savings, in a way that doesn't jeopardize their immediate stability. This ties into embracing mastery of cash flow. Understanding where every dollar goes allows them to make informed decisions about where it can go.
That makes sense. It's about building that strong base first. Now, Mark and Lisa are a couple, and Mark's potential career change is a big decision that impacts both of them. How can couples effectively communicate and align their financial priorities when faced with changing circumstances, like this potential career shift?
Communication is the bedrock, Alex, and it needs to be ongoing, not just a one-time conversation when a crisis hits. For Mark and Lisa, this means scheduling regular money dates, dedicated times to talk openly about their finances, their fears, their dreams, and how a decision like Mark's career change fits into their shared vision. It's about understanding financial choices together. They need to explore the what-ifs. What if the income dip is larger or lasts longer than expected? What adjustments are they both willing to make?
I can see how that would be challenging. It reminds me of what we discussed about the importance of a shared financial vision in our earlier talks. But what happens if, say, Lisa is more focused on the immediate security implications of Mark's income dip, while Mark is more focused on the long-term benefits of better work-life balance? How do they bridge that?
That's a common scenario. The key is to acknowledge both perspectives as valid. Lisa's concerns about security are absolutely legitimate, especially with young children. Mark's desire for a more sustainable work-life balance is also vital for the family's overall well-being. This is where the flexibility part of the plan comes in. They can build in specific strategies to mitigate the risk of the income dip, perhaps by boosting their emergency fund beforehand, or identifying discretionary expenses they can temporarily cut. It's about finding a compromise that addresses Lisa's need for security while allowing Mark to pursue his goal. They're essentially trying to embody that Shelby the Tortoise idea we talked about. Strong protection, but still able to move and adapt.
That's a great way to put it, Sam. It's about making the plan robust enough to handle those different perspectives and potential changes. So let's talk more about that robustness. When you think about financial cushioning for a family like Mark and Lisa's, what does that practically look like, and how flexible does it need to be?
Financial cushioning is a multi-layered concept. It's not just one big emergency fund, though that's a critical piece. For a family like Mark and Lisa's, it involves 1. A robust emergency fund, aiming for 3 to 6 months of essential living expenses, perhaps even more given Mark's potential income change. This needs to be highly liquid and accessible. 2. Adequate insurance. This is a core part of creating a financial safety net. Life insurance to protect the family if something happens to either parent, disability insurance to replace income if one can't work, and appropriate health coverage. 3. Tiered savings. Beyond the emergency fund, having other accessible savings for predictable but irregular expenses. Think car repairs or annual insurance premiums. This reduces the need to dip into the core emergency fund. 4. Lines of credit. A home equity line of credit, for instance, could be a last resort safety net, but they need to understand the risks. The flexibility aspect here is crucial. Some of this cushioning needs to be immediately available. Other parts, like certain investments earmarked for longer-term goals, might be less liquid but still part of their overall security picture. With Mark's potential career change, they might temporarily increase the liquidity of their overall assets or build a specific income transition fund separate from their main emergency fund. This is where embracing financial flexibility, as our secured philosophy highlights, really comes into play. Their plan needs to be able to bend without breaking.
So, if I understand correctly, the cushioning isn't static. It needs to breathe with their life. If they know a change is coming, like Mark's career shift, they'd proactively adjust the type and amount of cushioning. For example, they might prioritize topping up that highly liquid emergency fund even more aggressively in the months leading up to his potential job change.
Exactly, Taylor. That's a perfect example of an adaptable strategy. They anticipate the change and adjust their financial shock absorbers accordingly. It's about being proactive, not reactive.
This has been incredibly insightful, Sam and Taylor. It's clear that for a growing family like Mark and Lisa, balancing today's needs with tomorrow's dreams, especially amidst big life changes, requires a proactive and adaptable approach. So, to quickly recap the key takeaways from this discussion. First, for families feeling that financial squeeze, the initial step is to gain clarity on your current finances and then prioritize your non-negotiable needs to build a secure foundation. Second, open, ongoing communication between partners is absolutely vital to align financial priorities and navigate changes collaboratively. And third, financial cushioning is more than just an emergency fund. It's a multi-layered system of protection that needs to be flexible and adapt to your family's evolving circumstances. For our listeners who might be in a similar situation to Mark and Lisa, our call to action for you this week is this. Review your family's budget for areas where flexibility can be introduced without compromising core security. Look for those discretionary expenses that could be adjusted if needed, and think about how you might bolster your financial cushioning. In our last segment, we explored the financial balancing act Mark and Lisa face as a growing family, juggling immediate needs with long-term goals like education funding. We talked about communication and creating that crucial financial cushioning. Next, we're shifting our focus slightly, moving along the timeline to someone closer to retirement, David. David is 58, he's built a solid nest egg, and he's looking at retiring in about 10 years. He's feeling that common concern about market volatility and how it might impact his savings, but he's also got big dreams. He wants to travel extensively, maybe even start a passion project that would need some capital. So he's really on that tightrope, wanting to protect what he's built, but also needing the flexibility to redefine what retirement looks like for him. This scenario we're calling the pre-retiree's pivot, securing the future, enjoying today. Sam, to kick us off, David's situation feels like a classic pre-retiree challenge. As retirement approaches, how do priorities often shift between accumulating wealth and preserving it? And where does flexibility fit into this new equation?
That's a great question, Alex. For decades, the primary focus for someone like David has likely been accumulation, growing that nest egg. As retirement looms, there's a natural and important pivot towards preservation. The mindset shifts from how much can I grow it to how do I make sure this lasts and is there when I need it. Market downturns feel much more threatening when you're about to start drawing from your savings rather than adding to them. Now, flexibility becomes key in a few ways. First, flexibility in how assets are protected. This might mean shifting to a more conservative investment mix, but not so conservative that it stifles any potential for growth to combat inflation. Second, it's about flexibility in accessing funds. David wants to travel and start a project. Those aren't typically fixed, predictable expenses. His plan needs to accommodate these variable draws without jeopardizing the core funds needed for essential living expenses throughout potentially a 30-plus year retirement.
So, it's less about just letting the money sit and more about making it work smarter, not just harder for this new phase. I always imagined retirement planning as just locking everything down in super safe, low-return investments. But it sounds like flexibility is about more than just the types of investments.
Exactly, Taylor. Locking everything down can actually introduce other risks, like inflation risk, the risk that your money doesn't grow enough to maintain your purchasing power over time. Flexibility here is about having a strategy that can adapt. Think of it our Shelby the Trustworthy Tortoise from our reference article. Shelby's shell offers protection, but she can still move and adapt to her environment. David needs that financial shell, but also the ability to navigate towards his travel dreams and passion project.
That's a helpful visual. It ties into the idea of adaptable strategies we touched on earlier, that life circumstances change and plans need to evolve. This brings me to my next question for you, Sam. What are common fears pre-retirees like David face? And how can a financial plan address both the need for security and the desire for adaptive strategies in later life?
The fears are quite common: outliving their money, or what we call longevity risk, the impact of inflation, as I just mentioned, unexpected healthcare costs, and of course, significant market downturns right before or early in retirement, known as sequence of returns risk. That's when a big drop in your portfolio value at the wrong time can really impact how long your money lasts. A robust plan addresses these by incorporating layers of security. This is where our secured philosophy, particularly create a financial safety net, comes into play. This isn't just about an emergency fund anymore, it's about a comprehensive strategy. This might include dedicated income streams, annuities or bond ladders for predictable income for essential expenses, strategic asset allocation, balancing growth potential with risk management, healthcare planning, factoring in potential medical costs, perhaps through specific savings vehicles or long-term care insurance, contingency plans. What if one of his dreams, like the passion project, requires more capital than expected? The plan needs to have what-if scenarios built in. The adaptive strategies part means the plan isn't set in stone. It allows for course correction. For David, this means if the market does well, he might have more freedom for discretionary spending like travel. If there's a downturn, the plan has buffers and strategies to protect his core capital, perhaps by temporarily reducing discretionary withdrawals. It's about understanding financial choices and their implications.
So if I understand correctly, it's like having different buckets of money, or at least different mental accounts, some for the absolute must-haves, and others that have a bit more give and take, depending on what life throws at you or what new opportunities David wants to pursue. This reminds me of what we discussed about embracing mastery of cash flow for younger folks, but it sounds even more critical when you're managing a finite nest egg for an unknown number of years.
Precisely, Taylor. The principles are similar, but the stakes and time horizons change. That embrace financial flexibility aspect from Secured is paramount. Instead of a rigid withdrawal rate, we might look at dynamic withdrawal strategies that adjust based on market performance and David's actual spending needs.
That makes a lot of sense, building in that responsiveness. So, Sam, let's get practical for David. He wants to travel, maybe start that passion project. How can David explore options like phased retirement or flexible spending in retirement without compromising his long-term financial stability?
Phased retirement is an excellent option for some. Instead of going from full-time work to zero, David might reduce his hours, take on consulting work in his field, or even start that passion project on a smaller scale while still earning some income. This lessens the immediate draw on his retirement savings, allowing them more time to potentially grow, aligning with reap benefits of compound growth, even as he's starting to transition. It also provides a psychological bridge to full retirement. For flexible spending, a common approach is to categorize expenses. 1. Essential: housing, food, healthcare, covered by more secure income sources. 2. Discretionary: things like regular travel, hobbies, funded by a more flexible portion of the portfolio. 3. Aspirational: the big passion project, luxury travel, funded if investments perform exceptionally well or from a dedicated opportunity fund set aside. This way, if markets are down, he might postpone the aspirational goal or scale back discretionary spending, protecting his essentials. This requires seizing financial control even in retirement, making active, informed decisions.
I can see how that tiered approach to spending would give him confidence. It's not an all or nothing on his dreams. He can adjust the sails depending on the financial weather, so to speak. But what about the capital for the passion project? If it's a significant amount, how does he ensure that doesn't derail the sustainable financial stability we talked about?
That's a key consideration. The capital for the passion project would ideally be earmarked and segregated, perhaps after a thorough analysis of its potential impact on the overall plan. It might mean deciding to allocate a specific portion of his aspirational bucket to it. Or, if he pursues phased retirement, some of the income earned during that phase could be directed towards capitalizing the project. The plan would stress test this withdrawal. We would look at it and say, if David pulls out X amount for this project in year 3 of retirement, what does that do to the longevity of his overall portfolio under various market conditions? It's about making an informed trade-off, understanding financial choices fully.
It really underscores that financial planning isn't a one-time event, especially around retirement. It's an ongoing process of monitoring, adjusting, and aligning with evolving goals. So to quickly recap what we've discussed for someone like David, who's in this pre-retiree pivot, priorities shift from pure accumulation to a balance of preservation and continued, albeit more cautious, growth. Flexibility is crucial, not just in investment choices, but in how and when funds are accessed to support variable goals like travel or new ventures. Common fears like outliving money or market crashes can be addressed with a multi-layered safety net and adaptive strategies, things like dynamic withdrawals and categorizing expenses. Practical options like phased retirement or clearly defined flexible spending plans can allow pre-retirees to pursue their dreams without unduly risking their core financial security. This really speaks to the safety net importance and adaptable strategies that the SafeSimpleSound approach and our reference article emphasizes. For our listeners, especially those in a similar stage to David, if you're approaching retirement, map out your ideal lifestyle: the travel, the projects, the day-to-day. Then take a hard look. Does your current financial plan have the robust security and the built-in flexibility to support it? In our last segment, we were exploring the financial tightrope walk with the pre-retiree's pivot, looking at David, who's about 10 years from retirement. He's built a solid nest egg, but is increasingly concerned about market volatility, yet still wants the flexibility to travel and pursue passion projects. It really highlighted that tension between protecting what you've built and still making room for growth and life's adventures. Next, we're diving deeper into the characteristics of what we call a Shelby, our metaphor for a security and flexibility seeker, inspired by Shelby the Trustworthy Tortoise from our article, Financial Security with Flexibility. These are folks who, like Shelby with her protective shell, prioritize safety but still need to move forward. Our scenario for this discussion is the cautious investor rebuilding trust. I want you to picture Maria. A few years back, Maria experienced a significant loss from a high-risk investment. As you can imagine, she's now extremely wary of the market. Her number one priority is asset protection, but she's also savvy enough to know she needs some growth to meet her long-term goals. She's looking for an approach that makes her feel safe, like Shelby, but still allows her to make financial progress. This really brings up some crucial questions. Sam, Taylor, let's start here. If you've had a negative investment experience like Maria, how does that shape your current approach to financial risk and security?
Oh, that's a big one, Alex. I can only imagine how Maria feels. Even without a major loss, I know that when I've seen my small investments dip, even temporarily, there's this knot in my stomach. If it were a significant amount, I think wary would be an understatement. I'd probably want to wrap my money in cotton wool and hide it under the mattress. It must make it incredibly hard to trust the market or even financial advice again.
You're absolutely right, Taylor. A significant loss can be financially and emotionally scarring. It often recalibrates an individual's entire perception of risk. What might have seemed like an acceptable risk before the loss can feel utterly terrifying afterwards. For someone like Maria, her safety net importance, as we call it in our framework, becomes paramount. The primary focus shifts dramatically towards protection of assets, almost to the exclusion of everything else, at least initially. Rebuilding that trust is a slow process and requires a lot of transparency and demonstrable safety.
That makes perfect sense. It's like if you burn your hand on a stove, you're going to be extra cautious around heat for a long time. So, for Maria, who now prioritizes this capital preservation above all else, what does balanced growth actually mean? It sounds almost contradictory to her current mindset.
Yeah, I was wondering about that. Balanced growth sounds good, but if I were Maria, growth might still sound like risk. How do you balance something when one side of the scale, safety, feels like it needs to weigh a ton, and the other side, growth, feels like a feather you're scared will blow away?
That's an excellent way to put it, Taylor. For someone like Maria, balanced growth takes on a very specific meaning. It's not about chasing high returns. It's about achieving sustainable financial stability with modest, reliable growth that critically doesn't expose her to the same level it caused the previous loss. Think of it as aiming for a slow and steady incline rather than a volatile mountain range. The balance comes from strategies that heavily emphasize risk management and might include a greater allocation to lower volatility assets or products designed with capital preservation features. The growth component is secondary but essential for not losing purchasing power to inflation over time.
So, it's less about high speed racing and more about ensuring the vehicle is incredibly safe and makes steady, reliable progress. That brings us to the practical side. How can a Shelby, someone like Maria, find financial products or strategies that offer that robust protection without completely sacrificing the potential for returns? She needs that shell, but the tortoise still needs to move.
This reminds me of what we discussed about Shelby the tortoise in the article. She combines the protection of her shell with the ability to adapt to her environment. So Maria needs that strong financial shell. What does that look like in terms of actual strategies? Is it all about bonds, or are there other options?
Exactly, Taylor. The shell is crucial. First, transparency is key. Maria needs to fully understand financial choices, which is a core part of our secured philosophy. This means clear explanations, no jargon, and a full picture of how any strategy works, especially its risk components. Practically speaking, this could involve a few approaches. 1. Diversification, but with a conservative tilt. Spreading investments across different asset classes is standard, but for Maria, the mix would likely lean more towards historically less volatile assets like high-quality bonds or even cash equivalents for a portion, while still including some equities for growth, perhaps focusing on companies with strong fundamentals and lower volatility. 2. Strategies with built-in risk management. This could include things like buffered ETFs or structured notes that offer a degree of downside protection, though these have their own complexities and trade-offs that need to be thoroughly understood. The premiums were initially higher comment from the client testimonial in our article often applies here. Sometimes robust protection or flexibility has an explicit or implicit cost. 3. Focus on adaptable strategies. As Maria regains confidence, her strategy might need to evolve. The plan shouldn't be so rigid that it can't accommodate a potential gradual increase in her comfort with risk or changes in her financial goals. The ability to adjust the policy as my financial situation evolves, as that client mentioned, is vital. 4. Prioritizing understanding and comfort. Ultimately, the best strategy is one Maria understands, feels comfortable with, and can stick to. If a strategy causes her constant anxiety, it's not the right fit, even if it looks good on paper. It's about helping her seize financial control by building confidence in her decisions again.
So it's a combination of the right tools and a strong emphasis on her understanding and comfort level. It sounds like for Maria, the process of choosing investments is just as important as the investments themselves. She needs to feel that her risk awareness is being fully respected and addressed.
That makes a lot of sense. So if I understand correctly, for someone like Maria, a Shelby, it's not about avoiding all risk, because that's almost impossible if you want any growth. It's about carefully selecting and understanding risks, prioritizing strategies that have strong protective features, and building a plan that feels secure enough to let her sleep at night, even if it means a slower journey to her growth goals. The shell is the priority, but it's a shell designed for steady, forward movement.
Beautifully summarized, Taylor. You've hit the nail on the head. For Maria, and many Shelbys like her, Rebuilding trust starts with transparency, prioritizing asset protection, and finding strategies that offer that crucial balance of safety and modest, sustainable growth. So, the key takeaways here are: first, a significant negative investment experience profoundly impacts risk perception, making safety net importance and protection of assets the top priorities. Second, for such cautious individuals, balanced growth means prioritizing capital preservation with modest, reliable returns rather than chasing high growth. And third, strategies for a Shelby like Maria must be transparent, potentially involve conservatively tilted diversification or products with downside protection, and be adaptable, always ensuring she understands and feels comfortable with the approach. This brings us to our call to action for this segment. Evaluate your risk tolerance. Are you truly comfortable with your current investment mix, or is fear dictating your decisions? It's a really important question to ask yourself honestly. We're shifting gears slightly, but sticking with our theme of identifying the Shelby, those security and flexibility seekers. We're looking at a different kind of challenge: managing variable income. Let's consider James, a freelance writer. He loves the freedom of his work, the ability to choose his projects, but his income can swing wildly from one month to the next. This makes it tough for him to plan for big expenses, save consistently, or even just feel that baseline financial security we all crave. He really needs a system that adapts to his irregular cash flow while helping him build a strong safety net and allow for future growth. Sam Taylor. This scenario of James the freelancer really highlights the need for both security and flexibility. So, to kick us off, for freelancers like James with fluctuating income, what are the biggest challenges in establishing a sense of financial security?
That's a great question, Alex. The primary challenge is the unpredictability. Unlike someone with a steady paycheck, James can't easily forecast his income. This directly impacts his ability to budget consistently, makes it harder to commit to regular savings or investment contributions, and can create significant stress when planning for larger, irregular expenses like annual insurance premiums or even just quarterly tax payments. There's also an emotional component. The feast or famine cycle can be draining and make long-term security feel elusive.
That makes total sense. I have a friend who's a freelance graphic designer, and she talks about this all the time. She'll have a fantastic month and feel on top of the world, then a really slow one where she's questioning everything. It's not just about the numbers, is it? It's about that feeling of stability. So if that's the challenge, Alex, your next question is spot on.
Exactly, Taylor. So, Sam, how can adaptable strategies and what our reference article calls mastery of cash flow specifically help someone like James in the gig economy build a resilient financial plan?
Adaptable strategies are key here. For James, this means moving away from a rigid, fixed monthly budget to something more dynamic. Think percentage-based budgeting, where he allocates percentages of whatever income comes in to different pots, say 50% for essential living, 20% for taxes, 15% for savings, 10% for business expenses, and 5% for discretionary spending. This adapts automatically to his income level. Mastery of cash flow, which the article highlights under our secured philosophy as embrace mastery of cash flow, involves a few things. Firstly, building robust emergency reserves is non-negotiable for a freelancer. Secondly, it's about creating flexible spending strategies, knowing what's essential versus discretionary, and being able to scale back quickly if needed. And thirdly, it's about optimizing that income, perhaps by setting up separate accounts to smooth out the peaks and troughs, like a salary account he pays himself from.
So if I understand correctly, mastery of cash flow isn't just about tracking expenses. It's more about designing a system that anticipates and absorbs the income shocks. Like, instead of just hoping for a good month, James is actively channeling funds when they do come in to prepare for the leaner times. This reminds me of what we discussed earlier about financial cushioning for families. It's just a different application for a different kind of uncertainty.
Precisely, Taylor. It's about creating that buffer and a system that doesn't break when income dips. For example, when James has a high income month, a higher absolute amount goes into his savings and tax accounts, even if the percentage stays the same. This helps build up reserves faster to cover those lean months or unexpected big bills. It's proactive, not reactive.
That's a really clear way to put it, Sam. It's building resilience into the system itself. This brings me to my final question for this scenario. What kind of safety net is most crucial for an entrepreneur or freelancer like James? And how can it be designed with that essential flexibility in mind?
For a freelancer, the safety net has a few core components. The emergency fund is paramount, as we've discussed. Ideally, aiming for 6 to 12 months of essential living expenses, given the income variability. Beyond that, think about income protection. Disability insurance becomes incredibly important. If James can't work due to illness or injury, his income stops. Health insurance is also critical, often a significant and variable expense for freelancers. To design it with flexibility, for the emergency fund, he might have a tiered approach, a very liquid cash portion for immediate needs, and perhaps a slightly less accessible but still safe portion for longer-term emergencies. For things like insurance, understanding the policy options is key. Some might offer riders or features that allow for adjustments if his circumstances change, though this needs careful review. The goal, as the article mentions when talking about create a financial safety net, is to build multiple layers of security.
It sounds like the shell for Shelby the Tortoise, in James's case, needs to be quite robust, but also allow for a lot of movement. So it's not just one big emergency fund, but a combination of things: savings, the right insurance, and those cash flow systems we talked about. It makes me think, though, how does he balance building this super strong safety net with wanting to grow his money or invest for the future, especially when his income is so up and down?
That's the classic balancing act. The safety net comes first. Once that foundational security is in place, or at least a solid plan to build it systematically, then he can look at allocating a percentage of his income towards longer-term growth, again using that flexible, percentage-based approach. It's about prioritizing. Secure the present and near future first, then consistently allocate for the longer term.
This has been a fantastic breakdown. So to recap for James, our freelance writer, and anyone in a similar situation, the key challenges are income unpredictability and the difficulty that creates for traditional planning. The solution lies in adopting adaptable strategies like percentage-based budgeting and truly mastering cash flow by building robust emergency reserves and flexible spending plans. And that crucial safety net isn't just one thing. It's a multi-layered approach, including a significant emergency fund and essential insurance like disability and health cover, all designed with as much flexibility as possible. This really highlights how someone like James, who needs that flexibility to thrive in his freelance career, is a perfect example of a Shelby, seeking that strong shell of security, but also the ability to adapt and move. And for our listeners, our call to action for this segment is, if your income is variable, explore budgeting methods designed for irregular cash flow and prioritize building a robust emergency fund. Now we're diving deeper into the very first pillars of our secured philosophy: seize financial control and embrace mastery of cash flow. We're using a scenario we're calling From Financial Fog to Clarity. Imagine someone, let's also call them Alex, who feels perpetually overwhelmed by bills, student loans, and credit card debt. They genuinely aren't sure where their money goes each month and lack confidence in making financial decisions. Their dream is simply to feel in control and build a stable foundation. Sam, Taylor, this feeling of financial fog is incredibly common, isn't it?
Oh, absolutely. I think many listeners, myself included at times, can relate to that feeling of just treading water, or worse, feeling like you're sinking a bit each month.
It is. And it's often the biggest hurdle to overcome, that initial sense of overwhelm. But the good news is, clarity is achievable.
That's exactly what we want to unpack. So Sam, for someone like the Alex in our scenario, what are the first practical steps to seize financial control when everything feels chaotic?
The very first step, Alex, before any grand plans or strategies, is simply to understand the current reality. To seize financial control, you need to know what you're controlling. This means creating a reliable financial foundation, and that starts with awareness. Specifically, tracking where your money is actually going. No judgment, no immediate changes, just observation.
That sounds straightforward, but if you're already feeling overwhelmed, Even looking at your bank statements can be anxiety-inducing. You might not want to know. How do you push past that?
That's a crucial point, Taylor. It's about making it as low friction as possible. It doesn't have to be a complex spreadsheet on day one. It could be a dedicated notebook where you jot down every expense for a week, or a simple tracking app. The goal is to gently lift that fog. The reference article mentions building confidence in financial decisions, and that confidence often starts with just knowing your numbers. It's less about immediate restriction and more about illumination.
So it's like turning on a light in a dark room. You might not like everything you see initially, but at least you can see. That makes sense. Okay, so once you have a clearer picture, how does embracing mastery of cash flow go beyond simple budgeting to create robust emergency reserves and flexible spending strategies, even on a tight income?
Embracing mastery of cash flow is about becoming the director of your money, not just an observer or a victim of it. Simple budgeting can feel restrictive, like a financial diet. Mastery, however, is about understanding your income, all sources, and then strategically allocating your expenses. This includes critically prioritizing robust emergency reserves, as the framework highlights. Even if you start by saving a very small, consistent amount, it builds. For flexible spending, it's about identifying fixed costs versus variable costs, and then creating flexible spending strategies for those variable areas, like groceries, entertainment, or personal care, so you can adapt month to month without derailing your core financial stability.
So if I understand correctly, mastery isn't just about cutting back. It's about intelligently deciding where each dollar goes, ensuring some of it goes to that safety cushion, the emergency fund. But if your income is really tight, how do you create flexible spending strategies? It feels like there's no flex.
That's where the optimize income for security aspect, also from our framework, can come into play in the long run. But in the immediate term, with a tight income, flexibility might mean making conscious trade-offs. For example, one month you might allocate more to a clothing budget if needed and less to eating out. The next month, that could flip. The key is that you are making the decision proactively. This is very different from reactive spending, where the money just seems to disappear. Even a small emergency fund, say $500, creates a buffer that prevents a minor, unexpected expense from becoming a major debt, helping you maintain cash flow through transitions.
That's a great point, Sam. It's about proactive choices. This reminds me of what we discussed about Shelby the Tortoise earlier. That sturdy shell providing protection, but still allowing for movement and adaptation. That emergency fund is part of the shell. Now, this ties into my next question. What does establishing clear financial boundaries look like in daily life for someone trying to get control of their spending and saving habits? This is listed under C's financial control.
Establishing clear financial boundaries is about setting up some guardrails for your spending and saving. In daily life, this could be things like deciding on 1 or 2 no-spend days per week, or setting a specific, realistic limit for impulse purchases. Say anything over $20 requires a 24-hour cooling-off period. It could also mean automating savings transfers on payday before you have a chance to spend that money. These boundaries help you maintain control through life changes because they build habits that aren't solely reliant on willpower, which can fluctuate.
So these boundaries are almost like pre-made decisions. For instance, if I know I tend to overspend on online shopping, a boundary might be to remove saved credit card details from websites, adding a deliberate friction point. Is that the kind of thing you mean? It helps you stick to the cash flow plan you've made.
Precisely, Taylor. It's about designing your environment and your habits to support your financial goals. Those boundaries reinforce the mastery of your cash flow and solidify your control. It's about making it easier to do the right thing for your finances.
This is so helpful. It feels like we're really breaking down what can seem like an insurmountable problem into manageable actions. So let's do a quick recap. For anyone feeling that financial fog, like the Alex in our scenario. 1. Seize financial control by first, gently, and without judgment, tracking your income and expenses to understand your current situation. This builds your financial foundation and confidence. 2. Then, embrace mastery of cash flow by not just budgeting, but by strategically directing your money. This includes building those crucial emergency reserves and creating flexible spending plans, even if you start small. 3. And underpinning all of this is establishing clear financial boundaries, those practical rules you set for yourself to make good financial habits stick. Sam, does that capture the essence?
Beautifully summarized, Alex. It's about moving from a reactive state to a proactive, empowered one.
Fantastic. This gives a clear starting point. And for our listeners who are ready to take that very first step out of the fog, our call to action for this segment is this. Start by tracking all your income and expenses for 1 month to truly understand your current cash flow. You can use a notebook, a simple app, or a spreadsheet, whatever works for you. The goal is awareness. Next up, we're looking at the C and U, create a financial safety net, and understand financial choices, particularly around protection. To illustrate this, let's consider Maya and Ben. They're a young couple, new baby, new home, lots of excitement, but also those nagging what-ifs. What if one of them loses a job? What about unexpected medical bills or something happening to their home? They want to build a robust financial safety net for peace of mind. Sam, Taylor, this is a really common scenario. So let's start here. 1. Beyond an emergency fund, what are the critical layers of a financial safety net for a family like Maya and Ben's? 2. How can they understand financial choices to ensure they have the right type and amount of insurance without feeling pressured or confused? 3. And what does it really mean to protect against various risk scenarios? And how can families like Maya and Ben prioritize these risks? Sam, let's kick off with that first question about the layers of a safety net. Most people think emergency fund, and that's vital, but what else constitutes a truly comprehensive safety net?
That's a great starting point, Alex. The emergency fund is definitely the bedrock, that liquid cash to cover immediate, unexpected expenses, typically 3 to 6 months of essential living costs. But for Maya and Ben, with a new baby and a mortgage, the safety net needs more layers. Think of it like a medieval castle's defenses. You have the moat, but you also need strong walls, watchtowers, and guards. These additional layers primarily involve various types of insurance. We're talking about life insurance, especially crucial now they have a dependent and a mortgage. If something happens to one of them, the surviving partner and child need financial support. Disability insurance. This is often overlooked, but statistically, you're more likely to become disabled during your working years than die. This protects their income if one of them can't work due to illness or injury. Health insurance, a must-have, particularly with a baby. Medical bills can be financially crippling without it. Homeowners insurance protects their significant new asset, the house, and its contents. Auto insurance, if they have a car, this is legally required and financially essential. And slightly less direct, but still part of that protective layer, things like having a will and powers of attorney in place become increasingly important with a child and assets.
That's a lot of layers, Sam. For Maya and Ben, who are probably already feeling the squeeze of a new mortgage and baby expenses, how do they even begin to prioritize these? It feels like a huge additional financial burden. Is there a sequence to it, or is it all equally important at once?
That's a very practical question, Taylor. It's not about getting everything maxed out overnight. It's about a strategic, phased approach. The emergency fund is priority 1. Then, for Maya and Ben, life insurance and health insurance would likely be next in line due to the baby and the mortgage. Disability insurance is also very high on the list. Homeowners insurance would have been a requirement for their mortgage, so that's in place. The key is to address the risks that would have the most catastrophic financial impact first.
So it's about identifying those biggest vulnerabilities. This leads perfectly into my second question, Sam. Once they've identified these needs, particularly around insurance, how can Maya and Ben understand financial choices to get the right coverage? The insurance world can feel like a minefield of jargon and sales pressure.
Absolutely. The understand financial choices pillar of Secured is critical here. It's about empowering them, not overwhelming them. First, they need to understand that insurance is risk management, not an investment. The goal is to transfer specific financial risks to an insurance company for a premium. Second, they should work with someone who can explain things clearly. What are the policy terms? What are the deductibles? What are the coverage limits? And why are they recommended at certain levels? I'm reminded of a client testimonial we have in our reference materials where someone mentioned that while premiums were initially higher than expected, the advisor clearly explained the long-term benefits and the flexibility to adjust the policy. Once I recognized the true value and adaptability of the coverage, I felt confident and secure. That's the goal. Understanding leads to confidence.
That makes sense. So if I understand correctly, for Maya and Ben, it's not just about buying an insurance policy, but understanding why they need a specific type, like term life insurance versus whole life, and how much coverage is appropriate for their specific situation, like covering the mortgage and childcare costs if one of them were no longer there, and knowing they can ask questions until it makes sense, right?
Precisely, Taylor. For example, with life insurance, a common approach is to calculate needs based on covering debts, income replacement for a certain number of years, and future expenses like education for the child. It's about a needs-based analysis, not a one-size-fits-all product pitch. Understanding the why behind the what is paramount.
This is so important. It's about making informed decisions rather than reactive ones. Okay, let's tackle that third question. What does it mean to protect against various risk scenarios, and how can families prioritize these risks? Sam, can you break that down?
Protecting against various risk scenarios means taking a 360-degree view of potential financial threats. We've touched on many: loss of income due to job loss, disability, or death, major unexpected expenses, significant medical bills, major home repairs not covered by standard homeowners insurance, property loss, damage to their home or car, liability, being sued for causing injury or property damage. Prioritizing these comes down to assessing two factors for each risk. 1. Likelihood, how probable is this event? 2. Severity, if it happens, what's the financial impact? A low likelihood, low impact risk can be self-insured via the emergency fund. But a low to moderate likelihood, high impact risk needs a formal insurance solution.
So for Maya and Ben, a house fire might be statistically less likely than, say, a minor illness, but the financial impact of a house fire is catastrophic. So that's a high priority risk to insure against. Whereas a job loss, which could be moderate to high likelihood depending on their industries, would primarily be covered by the emergency fund, and perhaps their own career resilience strategies, though income protection from something like disability insurance helps here too, if the job loss is due to health. It's about that balance, isn't it?
Exactly. You're creating multiple layers of security, as the secured philosophy outlines. The emergency fund handles smaller shocks, while insurance and other protective measures handle the larger, potentially devastating ones. It's a comprehensive protection strategy.
This has been a fantastic breakdown. So to quickly recap for Maya and Ben and for our listeners, first, a financial safety net is multi-layered. It starts with an emergency fund, but extends to crucial insurance coverage like life, disability, health, home, and auto, plus things like a will. Second, understanding financial choices means not just buying insurance, but comprehending policy terms, coverage needs, and ensuring it aligns with your specific situation to manage risk effectively. It's about feeling confident, not confused. And third, protecting against various risk scenarios involves identifying potential threats and prioritizing them based on likelihood and financial impact. Then using the appropriate tools, like insurance or emergency savings, to mitigate them. This really highlights how creating a financial safety net and understanding financial choices work hand in hand to build that resilience Maya and Ben are looking for. Now, for our listeners, here's a call to action. Conduct a personal risk assessment. Take a few minutes this week to identify the top 3 financial risks your family faces. Then, honestly evaluate your current preparedness for each. Are there gaps in your safety net? And just like that, we've reached the end of another episode here on Safe Simple Sound. What a journey today, eh? We really dug deep into balancing that crucial tightrope walk between financial security and the flexibility that life inevitably throws our way. We started by acknowledging that challenge. Just like the article, Financial Security with Flexibility, Is Safe Simple Sound Your Answer? Does so well. And I hope you're all now picturing Shelby the Trustworthy Tortoise, that fantastic image of having a strong, protective shell while still being able to adapt and move forward confidently. That's the essence of what we discussed, building robust protection that doesn't stifle your ability to live and adapt. We explored what this looks like for young professionals like Sarah, trying to save while enjoying life, for growing families like Mark and Lisa, juggling present needs and future dreams, and even for pre-retirees like David, looking to protect their nest egg while redefining retirement. We then dove into identifying those Shelby characteristics. Perhaps you saw a bit of yourself in Maria, the cautious investor, or James, the freelancer navigating variable income. The core message, tying back to our Safe, Simple, Sound approach, is that you can have both. You can build a financial plan that offers genuine peace of mind through security, while also allowing you the freedom to pivot, grow, and embrace opportunities. Thank you truly for tuning in and investing your time with us today. We love having you as part of the Safe, Simple, Sound community, and we hope you found today's discussion empowering. If today's episode resonated with you, please do check out the show notes for links to the reference article and other resources we mentioned. We'd also be incredibly grateful if you could take a moment to leave us a review on your favorite podcast platform, share this episode with someone who might find it helpful, and of course, hit that subscribe so you don't miss out on what's next. We'll be back soon with another episode, continuing our mission to provide guidance that is, as always, safe, simple, and sound. Until then, keep building that secure and wonderfully adaptable financial future. This is Alex signing off. Take care, everyone.